So happy to be here. I know over the years I've been a part of the building blocks, and tonight I'm excited to share some new information, kind of building on what we've talked about the last couple years, to give you some insights as to how the industry is changing, and more importantly, what you can do to make sure you're maximizing your credit score. And let me just jump right in. I'll share my screen, my presentation. Okay. Can everybody see my screen?
Yes, sir.
Okay, great, great. So, so let me just go ahead and we're going to start with the hot topics of the day. And what we're going to do is we're going to do a credit score refresher, just so everybody kind of where we've been and where we're going to go. I'm going to talk about some legislative updates, some extra information that I think is very valuable for you right now, and then of course the top frequently asked questions that we get a lot in the industry. And so basically, what is a credit score? And, we've talked about this, and this three-digit number now is so important. It basically determines whether or not you can get an apartment, get a mortgage for a house, what kind of interest rate you're going to get for your car. Not only is it now being, approval or not approval, but it's also dictating which interest rate you get. And mortgage in the mortgage world, it's whether or not you're going to pay a higher rate for your mortgage insurance. I mean, just so many different things are tied to this particular three-digit number, and a lot of people don't really know, how this number is derived, more importantly, what they can do to try to keep it as high as possible, and what to do if there's a problem with it, do no fault of your own, a mistake or something like that. So what we're going to do is, it's basically a statistical model that's used to evaluate the credit worthiness of you, based on all the credit information that's in your profile at any point in time. So keep in mind, this is just a snapshot of just today. If your credit report is pulled today, it's what's at the bureau level as we're looking today. Just to kind of recap, there's three national repositories. There's Equifax, there's Experian, and there's TransUnion. And what's interesting is they're all competitors. They don't share information, and they all can report at different times. And your creditors, like your credit card company, your car loan, they all report to the national repositories. And there's a system in place where they give the data, and then there's kind of a back and forth, financial incentives or ways to market consumers that they exchange that information back and forth. It's not mandated. There's no law that says that a creditor has to report. And there's some creditors, even today, that don't report to all three. They may just report to just Equifax or just TransUnion. We're seeing less and less of that, but it can still exist, which is why, let's just say you have a late payment on one particular installment loan that's just being reported to one bureau. That one bureau may have a much lower credit score than the other two. So that's why you see those differences in score, because not all that information is the same. I'm going to go ahead and go to the next one here. The credit score timeline. The credit scores that we all use today are primarily started by FICO. And FICO, it's Fair Isaac and Company, and it was founded in the 1950s. And what they tried to do was say, hey, we were starting to accumulate all this data, and how do we manage this data, right? So as the 1970s came along, they tried to put together some different models to say, okay, if somebody pays all their bills on time, we don't want to sit there and actually have to look at each and every single trade line that they're doing. We just want to get some kind of grading system. As that started to evolve in the 1990s, Fannie Mae and Freddie Mac, they're the big purchasers of mortgage, and they pool all the mortgages together for the country. They came in and said, hey, you know what? We want to require usage for this because we know that if we can do a credit score, we can free up our resources and do a lot more loans and process them a lot faster by looking at the three-digit number as opposed to going through pages and pages of data. So that's what happened in the mid 90s. As we went through the late 90s and early 2000s, we basically had different revisions of those credit scores that were more specific to mortgage. And that's the industry that I'm really primarily focused on. But of course, auto industry, insurance. I mean, so many different industries have their own versions of the credit score, and it kind of goes back to what they're looking for from their population of people that they're doing business with. So, what ends up happening is we get to just this last couple years where in 2017 a new competitor came along, VantageScore, and that was released. And now we're getting into today where FICO 10T has now been released, and we now got the GSEs, which is Fannie and Freddie that buy all these mortgages. They're now going to start accepting these new scoring models. And why that is so important is because these new credit scoring models give some major advantages to the consumer. And that's going to allow overnight some people that can't get a loan today, they'll be able to get a loan tomorrow, and primarily in the mortgage space. So I'm going to go ahead and kind of go through just to kind of illustrate how it works here. You have yourself, you come in here and you apply for a loan with the lender. The lender then goes to the three credit bureaus. They grab your data. Then once they get your data, then it's run through the scoring mechanism that creates that credit score. Then it comes back to the lender where they, massage it, look at it, and see whether or not you qualify. And if you do qualify, what interest rate will be attached based on your score. Simultaneous to that, at the bottom, you see where other lenders are keeping track of whether you're paying or not, and they're sending that information back every single month to the credit bureaus. So that's kind of the way the system works and your particular place in the system. So with these new scoring models, just like I mentioned, there's some huge advantages coming for the consumer. And there's some similarities too, and I'll kind of just touch on the similarities where it's a consistent scoring range. So you're still going to use that 300 to 850 range of score. So it's not like you're going to see 1,000 or an A, B, or C. It's still going to be in that numerical range. You're going to have similar criteria as far as is what the lenders value, and that kind of goes back to all these investor pools. When they look at how these loans perform over a long period of time, they particularly pick out certain things that they want to look for. And they're still using proprietary scorecard technology, no matter which credit score is used. So some of the new, and this is where it's really going to be the meat and potatoes of what we're going to talk about tonight. And this is what's new and how you can position yourself to take advantage of this. The first piece is it's going to utilize trended credit data. And right now with the old scoring models, basically, again, it's a snapshot in time of just what's going on today. Trended data is going to kind of expand that out over 24 months so that it's going to look holistically and say, okay, well, David paid all of his bills and his credit cards down every single month for the last 23 months. And then just in that last month, he had a trip or something happened and he had a huge balance increase on his credit cards. Well, in today's world, that would be detrimental to my credit score. Whereas with trended credit data, it's going to smooth that out over time so that I'm not going to have as much of an impact on a huge increase or a real big problem that just happened. The flip side of that also is, if you have had a lot of debt for for the last 2 years, then this is one piece that could put a borrower at a disadvantage. But that's the only thing that could be a potential disadvantage for the consumer. The rest of these bullet points are really exciting, and we're going to go over some of these new codes that they're going to do. The first is they're going to allow collections to be treated differently. And why this is so important is that they realize that if I forgot to turn in my cable box, a year and a half ago, and I got hit with a $50 collection, that right now completely destroys my credit score. Even if I go and pay it off, I go and pay the money to Comcast or Cox, and I get it squared away, I'm still going to have a huge impact on my credit score. Well, they realize that, that doesn't really translate to not paying a mortgage for 30 years or even a car loan. So what they've said is, okay, from now on moving forward, any paid collection, the score is going to bypass that. So therefore, if you had a problem and you correct it and you pay it and get it resolved, now you're not going to have that huge 80, 100, 150 point drop in your credit score. So that's one huge piece that's positive. It's also going to differentiate unpaid medical debt from non-medical collections. so that any kind of medical collection, once it's paid, no impact at all on your score. Even if it isn't paid, there's still safeguards in place where it's not going to count against your credit score. So that there is another huge piece, because we see so many times where one spouse's insurance one spouse thought the other insurance was going to cover it. They missed a copay, and for a $30 copay, they get hammered on their credit score. So that's all changing with these new scoring models. So that's another huge positive. We're also going to look at the new scoring models are taking a look at rental data. So, a lot of times if somebody may want to pay cash for everything and they don't want to use a credit card, well, in today's world, it's very hard for them sometimes to get a loan. This is going to allow them to say, hey, I pay my rent on time. I have for the last 3 years. That can now be incorporated into the credit report. Also, any kind of telco or utility payments too, those that are not factored in today can be factored in on these new scoring models. So that's going to give a lot of lift to some people that right now don't even generate a credit score or have a really thin credit file. They can use those utility payments. They can use their rental, telco, different things like that to help build their credit score. So that's phenomenal. And it's such a positive, advancement, for the industry. And again, you get into this, the fundamentals are still true, though. You still want to make sure that, you're paying your bills on time. As far as credit cards go, you still want to make sure that you keep them paid down as low as possible. Because as we've talked about for the last couple of years, you get into those percentages, right? Where, if you have a credit card and it's got a $2,000 limit and you owe $1,900 on it, you're still going to get penalized because you're quote close to being maxed out on it. Whereas if you don't owe anything, you owe $10, then okay, you're not maxed out, and the score is going to treat you better in that scenario. So you still want to make sure revolving charge cards are paid down. You still want to make sure that all of your accounts are current and being paid every single month. One piece that people always ask me about is, okay, David, if I had my credit card payment due on May 1st and I missed it, here it is May 10th, let's just say, and I get hit with a late fee. So a lot of people say, oh my gosh, I'm already late. I'm just going to deal with this next month because I just want to allocate my resources elsewhere. Well, don't ever do that, because legally, all of this falls under the Fair Credit Reporting Act. And in order for you to legally be late with the bureau level to actually impact your credit score, you have to be 30 days late. So that means that if it's due May 1st, you have to have not paid by June 1st. Even if they internally mark you late and hit you with a small fee or something, don't worry about it. You still pay it as soon as you can, because as long as you pay it within that minimum payment within 30 days, you cannot be legally marked as being a 30-day late with the bureaus. So that's one thing that's very, very important, for consumers to understand is, make sure you're paying that as soon as you can, even if you do internally have a late payment with a creditor. The other piece that's still very important is to make sure that you're using your credit cards. We always use the example of somebody that may go and get a credit card at Target, let's just say, to get their 10% off, and they use it. They get the card home, they pay it off in 1 month, and then they put it in a drawer and never touch it again. You don't want to do that, because the models are always looking at each month of activity, and that'll always look like that credit card is unseasoned because it's only a month or two old. You want to make sure you're using all your credit cards at least once a month, so that counter keeps going, and then you end up with a card that's 60, 70, 80 months old, and the scoring models really like that, and that's the way to boost up your credit score. So those are the some of the tricks that we've talked about before and the tips that are still true today. But in addition, you've got these additional items here that can really be helpful. When we get into the percentages, again, what comes up your credit score is kind of like in school, what made up your grade at the end of the year, right? You still have those percentages. On the left-hand side, that's what we've gone over for years, and that's what we deal with the old scoring models. On the right-hand side, that's kind of the new. And again, the percentages are close enough, but again, you'll see some subtle differences there. But again, it's your payment history is always the biggest category. And that's simply, do you pay your bills on time each month. And if you do, that's going to be a huge component to a good credit score. The second one is the length and types of your credit. That's what we talked about how make sure you use those credit cards. If you do need to close an account, you want to be careful about, you don't want to close an old account that you've had for 10 years that's perfect, and then go replace it with a brand new card, because then the seasoning hasn't happened yet. So you want to be strategic. And a lot of times when we give these seminars, these are designed for people that want to be home buyers in the next year. So a lot of this advice is, hey, you want to put yourself in the best light for the lender. You want to have them go in, pull your credit report, see where you're at. And then, of course, if adjustments need to be made, companies like Tidewater Home Funding have the ability to tweak things and say, okay, we'll do this or do that, and we get you where you need to be. But all this advice is kind of general advice, thinking that, okay, you want to try to buy a house or a big ticket item at some point in the next year. And that also gets into the credit utilization. That's where I talked about those months, how old your accounts are. You get into credit balances. That's, again, that's those percentages that you're talking about, how much you're maxed out or not maxed out on a card. The recent credit applications, that's the same as the inquiries that we've talked about before. That's basically our lenders pulling your credit report. And there's two different types of credit pulls. There's a soft pull and there's a hard pull. And the soft pull is where, you have a current credit card, let's just say with Capital One. They can go in periodically and look at your credit. It's not a hard pull, it's a soft, because you've already got that relationship with them. If you go in as a consumer and access your credit report, that's a soft inquiry. The soft inquiries do not count against your credit score. There's no penalty for doing that. You can just, basically, it's all you can eat on the soft pulls with no problems. The hard pulls are inquiries that are initiated by a lender where they're going to extend credit to you. And those can impact your credit score, because the more you're shopping, theoretically, the lower your score can go. There are some safeguards that are put in place to give you a window of time that you can, quote, shop around. So if you do want to have your credit report pulled by multiple lenders, you want to make sure you do it in a compressed time frame. 30 to 45 days is typical on the new scoring models, and less than 30 days on the current scoring models. So those are just to kind of give you the update on the different percentages for the scoring models that are used. Again, the ranges fairly similar, but you get into anything over your 780 is going to be exceptional. Your 661 and higher is going to be very good. Your middle of the road is going to be your 601 to the 660, and then you can see how it drops down from there. If there are problems with the credit file, but those are the ranges, and that's going to kind of match up with what the lenders are going to do as far as, number one, qualification, but also number two, what kind of interest rate you're going to get. Obviously, the higher the credit score, the lower the interest rate is going to be. It's a general rule. So this is kind of like those credit score changes over time. I always like to, put this slide on just so you kind of see it as far as the mortgage space goes, the outline of the changes that they made. And just, last year, or 2 years ago, really, it started with the whole new scoring models and allowing lenders to try to use some additional scoring models to help borrowers out. And again, the 720 is not going to represent the same amount of risk. So again, you want to the bottom line here is, instead of trying to worry about all the different buckets and tiers of score, it's just, you want to keep your score as high as possible. And you want to do the things that we've talked about to make sure, it's as high as it possibly can be. The next piece I want to talk about are some legislative updates. And this is important because, everything that we do in the credit world is governed by the FCRA, which is the Fair Credit Reporting Act. And what this does is this gives a lot of power to the consumer as to what companies can put on your credit report, and what they can't. And, there's been some new legislation that you may have read about or heard about where there's a Homebuyer Privacy Protection Act that was signed last September. And what this does is there's a lot of different pieces to it, but the idea is that in order for companies to come and solicit you, there needs to be a permissible purpose. They need to have a reason now, either a prior business relationship or an ongoing business relationship where they can come in and trigger you if they want to get like a mortgage lead or something like that. It's one of these things where some companies may try to get you, to opt in, and of course that's your decision whether you want to opt in or opt out of these. But the legislation was passed and it is, effective today, which really limits how these companies can come after you to try to solicit your business. You also have other rights, and that is every single consumer has a right to go to each of the credit bureaus and get a free copy of their credit report. And there are a lot of free sites out there that offer this, but they're trying to sell you something, or there may be other things attached to some of those free sites. The site that's mandated by the federal government through the FCRA and through the bureaus is annualcreditreport.com. That is the best source to go if you're not, if you just bought your house and you just want to keep an eye on your credit. If you're looking to buy and you're going to be a purchaser in the next year, then the best advice is to go work with your loan officer, have them pull your credit, because then they're going to be able to say, okay, here's what we can do today. If there's any tweaks that need to be made, they can work with you on changing those balances or updating things through us to help make you loan ready. So those it's very important information just to know where to go and where not to go. The next piece here are the extra information tab that I want to go over. When I talked earlier about being able to self-report items like your rent or your utilities, a lot of consumers say, well, wait a minute, how do I do that? And Experian has set up a really great system called Boost. And you can just go to Experian Boost and you follow the prompts and it's free. And they'll basically start asking you questions and you can, fill out information so that they can start adding these non-traditional trade lines to your credit report. And again, the nice thing about it is on the new scoring models, these items are going to start to show up and they're going to start to help your credit score. So again, you just go to Experian Boost, follow the prompts, and go through there. And again, this is all planning for over the next year if somebody really wants to be able to increase the new version of the scoring model and be a home buyer. Will an inquiry impact my credit score? Well, yes, some do, many don't. We talked about the difference between the hard pull and the soft pull. And the key point to this is any kind of hard inquiry that's done in a short period of time will only count as a single inquiry. So again, if you want to shop around and have your credit report pulled by a bunch of different lenders, make sure you do it ideally within 30 days. And again, how to raise my credit score? The most important piece is to pay your bills on time, keep your balances low, only apply for credit when it's absolutely needed, and you want to be strategic about it. You don't want to just on a whim go and open up a Target card or open up a Best Buy card, because when you start doing that and you have too many cards, that can adversely affect your credit score as well. So you want to be consistent, and you want to try to keep ideally between 3 and 5 revolving charge cards, and you want to have them seasoned, meaning they all should really be over 6 months old. Before you really go and try to apply for a lot of credit. In no credit score, we see that a lot. And that's in order to generate a credit score, you have to have some account that's been on your credit file in the last 10 years. And typically you need to have it where there's been something reported in the last 6 months too. So if you had something that's 9 years, that satisfies the one requirement. But then if you just have a brand new card that's 1 month old, that'll satisfy the second requirement. So then you actually generate a credit score. So a lot of people, sometimes just get used to paying cash for things and they don't have anything current, and they go to the mortgage lender and no scores come up. So that's one thing you always want to be cognizant about, is that you have cards and you're using them every single month. My mortgage scores will match Credit Karma, and that is absolutely false. Again, there's a bunch of different credit score models out there. It's just like different versions of software for your computer or your phone. In the mortgage industry, they're very strict. They've got the current FICO models, they've got the 10T and the Vantage score that they will accept. But a lot of other models out there that you may see are designed for other types of products, and it's not going to match up correctly. So a lot of times, again, you want to go to the mortgage professional if you're looking at buying a house, have them pull your mortgage credit scores, and then kind of work from there to make sure that you're working on the exact scores that are going to impact your loan. And again, we talked about creditors are not required to report to all the bureaus, and that's why you do see some differences in credit score based on what types of data is being reported to your under your particular profile. So that was pretty much the updates that I had for everybody as far as what we're seeing with the new credit scores, kind of recapping a little bit about what we've talked about in prior years. I'm so happy